Hello, everybody, and welcome to Commodity Culture, where we break down the commodity space for both new and experienced investors. My name is Jesse Day, and before we get started, standard disclaimer, nothing here is investing advice. Do your own due diligence. And today's guest is the founder of Momentum Structural Analysis and a veteran of the finance industry with over 40 years of experience, which we hope to draw on today. Mr. Michael Oliver, it's a pleasure to have you on the show.
Thank you, Jesse. Thanks for having me on.
Great to have you on. I want to get started, as I do with all new guests, with the origin story. So how did you first discover investing? How did you start? And how did that ultimately lead you to the precious metals and the commodity space?
Oh, gee. My background was political philosophy. I was working on a PhD. This is the great global stagflation period, 73, 74, okay? At that point in time, I realized that my future in academia was probably not very good because I was a libertarian, okay, and that wouldn't fit at that time, okay. A friend of mine had joined Merrill Lynch as a commodity broker. He had a similar type background. He said, "Hey, come on in, the water's fine." Okay, so I checked around and I got hired by E.F. Hutton. Remember old E.F. Hutton? He used to be a great brokerage firm. Anyway, their headquarters is in Battery Park in New York, right down at the tip of the island, and that's where they were, and their national headquarters. And the commodity division was there. And the head of the commodity division there was also chairman of the COMEX. Now, this is the time when gold first started trading in the U.S., January of 1975. I got hired in April of 75. And I didn't know anything about markets. I knew a lot about gold, sort of from a philosophical point of view, but I wasn't savvy. And so I apprenticed there under him and learned about, rudimentary technical analysis, how markets work and so forth and so on. So anyway, it was an interesting start, but it was a heck of an interesting time because this is when gold first came on board. And of course, when it first came on board, it was making a bull market peak. It had already been running up since the early 70s from $30, went up to 200. As soon as they started trading, that was the top, like in the futures, and went down for the next year and a half to 1976, went down to $103. And I happened to be outside the pit the day that occurred. And there were like two brokers in the pit. That's how little volume there was. They were so upset that when gold was legalized, all the floor brokerage firms thought, oh boy, a whole bunch of volume of trading. And in fact, a bear market ensued. And so they're very disappointed. Then, of course, the bull market began and went to 850 by 1980. But anyway, so I lived during that time and learned during that time. I stayed a futures broker until 1992 when I was solicited by a major bank at the time that was headquartered not far from where I lived in North Carolina, Wachovia Bank, to provide them with my different kind of research. And my research was, at that point, I was a retail broker out in the system, so to speak, not in New York anymore. I was doing momentum work by hand. This is back before Excel, okay? So I'm plotting charts by hand. And what I would do is I would plot the price chart like everybody else does, but I would plot the bars, the daily or weekly or monthly bars, in their relationship to a moving average. And I don't mean overlaying the average, but using the average as a zero line. And the price is either so much above it or below it. And therefore, I'd create what I call a momentum oscillator. And I discovered over time, and especially in 87, I caught the crash. I didn't catch it big time. I didn't have a lot of money, okay, but I caught it. And I did it via quarterly momentum analysis of the Dow and the S&P, both of which, if you saw their momentum charts, forget the price charts. Price charts didn't tell you ahead of time. Momentum charts said, you're dead. And they had a floor that was so clear, a couple years wide, that you could not see it on the price chart. But on momentum, there's this floor. It kept hitting it. And when they broke it, it was the second week of October, you crashed. And 35% in a matter of days, And so I got smacked in the face by that reality, and I loved it. And so I started to develop it more and more. In 92, I started MSA, Momentum Structural Analysis. And our clients from 1992 through 2015 were institutional only. Mutual funds, hedge funds, banks, trust departments of banks, bond departments, and so forth. In late 2015, we opened it up to retail subscribers, Um, and, we look at all four different asset categories: bond markets, debt markets, foreign exchange, commodities, with special emphasis on gold, and stock markets. And boy, I can tell you that right now, looking at all those four categories is very important. If you're a gold bug, don't just focus on gold in the minors. You're making a big mistake. Look out the side mirrors, because the stuff that's going on out there is going to impact you either inversely or coincidentally, okay? And we think we're probably at the most historic market period in my lifetime. Is begun to unfold, and it's going to unfold over the next year or so. And it will be dramatic in a lot of markets, upside or downside, depending on the market. And commodities in particular, I think will be, let me put it this way, you're in a good spot, okay? Commodities will again become a focus, despite what the Fed thinks they're doing, that they will reassert themselves. And anyway, that's what momentum structural analysis does. We approach markets from a different technical point of view than most people who just look at price charts.
So before we dive into commodities, and I specifically want to talk about precious metals, I'd like to touch on the broader market first, because you've mentioned recently you think there'll be a bigger correction in broad markets. I've heard that sentiment echoed from several guests on this show, and from a historical perspective, something would really have to be different for that not to happen. So break down what you're seeing for us there and why you think there's more pain to come in the broader markets.
The first concept to integrate into your thought process is we've just had the biggest stock market bubble in U.S. history in terms of where we were in 2009 bear low to where we were at the 2021 high. It was one, the oldest bull market in history, and two, the biggest in terms of percent gain. S&P went up 7-fold. NASDAQ 100 went up 16-fold. You go back and look at the Dow in 29 from where it had begun. Look at the dot-com high in the year 2000 from where it had begun in the mid-1990s. Look at the 2007 high compared to the bear low in 2002 and look at the percent gain. They don't even compare to what the S&P has done, and certainly not to what NASDAQ has done. Then if you look at a money supply chart, M2, during the last 20 years or so, and look at Fed funds rate, you'll understand why this bubble occurred. It was a monetary stimulus created paper asset bubble. It didn't just move stocks, it also moved muni bonds, high yield corporate debt went up, yields down. It created paper asset bubble that lasted a very long time. So what that means is that people in reality, whether you're running a corporation, family planning, municipal government planning, your spending, even federal government, your assumptions were all based on false reality, falsely priced cost of money, and the availability of cheap money. It went on forever, And so you built your assumptions based on that reality. It wasn't just a couple of years, it was a dozen years, okay? So a lot of errors have been made on a micro level to a macro level. So many you can't define them all. When they come unwound and the Fed has now punched a big pin into their bubble, they said, we're going to fight inflation. Well, they had inflation. From 2009 low to 2021 high, you inflated the price of stocks. Now, they don't want to call that inflation. That's okay for them. Stocks go up or bonds go up. But if corn goes up, they don't like that. Heck with the corn farmers, okay. Or the cattle people or the copper miners, etc. But when commodities went up, they got all irritated because it affected some of their data points. Well, if you go back and look at where commodities were in late 2020, they were in the hole. They were what we call theoretical zero. In fact, from 2015 through 2020, while gold doubled in price, commodities continued down. There was no correlation between gold and commodities. But in October 2020, we put out a report called Commodity Explosion Coming. And the Bloomberg Commodity Index, which is a good one to watch because it's well balanced, went from the 70 price level to 140 by early 2022. In fact, it peaked a week or two after the war began, Ukraine and Russia war. Okay, so blaming the boom commodity price rise on that is a total lie. Okay, in fact, most commodities peaked right around the time that war commenced. Okay, since then, the commodity downturn has driven the Bloomberg from a peak monthly close at 130 plus, 131 area, peak monthly close, down to recently about 102. Now, it started from the 70s. Actually, its bare low was in the high 50s. Okay, so you've had a pullback, but it's been erosional. It's not been a collapse. We consider it to be a correction. And our assessment of the commodity market right now is, even though the Fed has punched a hole in the inflation bubble of stocks, which they really don't want to have done, and bonds, muni bonds, high yield corporate debt, commodities look primed to engage in another major upleg, and they're still cheap. You know, we hear this stuff about inflation at the highest in 40 years. Well, look at the Bloomberg. It's right now trading 103, 104. It's come off its recent low. You go back to 2008 and 2011 price levels. It was way up in the 200s. We're less than half of the price level we were 2008 to 2011. So on a historic basis, yeah, the move has been rapid percent-wise from the lows of a couple years ago. But in terms of where it is in real price, it's hardly a bubble. It's only doubled. S&P went up 7-fold, NASDAQ up 16. So when you punch a hole in the bubble, what's going to come unwound is what we're seeing, stock market. We turned bearish on the S&P in February of last year. It was 3 months off its high. We turned bearish on NASDAQ 100 in January of last year, like a month or two off its high. We argued that the first leg down in the stock market of the bear market, not a correction, would be an arm wrestling match, meaning zigzags. The kind of market that causes people to still have hope that, every rally is for real. It's an opportunity. It's balanced. The market's taking it well. We think the second leg is about to commence. The second leg down in the stock market will be more dramatic and will be very disappointing to people who thought over the last 9 months, since June low, for instance, last year, October low, the S&P's done this, meaning not gone down, but teased people. If you destroy that hope by moving back down through those lows, then desperation will set in and the tone of the market will change. Instead of being arm wrestling, it will be more obvious. We don't know where the stock market's going to go on the downside, except to say that we know that the bubble it's broken, is the biggest in history. Therefore, expect the consequences to probably be very bad. Worse than maybe 2008 and 9, probably so. That bubble was not a bubble, okay? But what will the central bank do? What will the Fed, the ECB, the Bank of Japan do once they realize that their assets that they want to defend aren't surviving? They're going to have to go back to what they were made to do: print money, support government debt markets at whatever cost, support muni bonds, high yield corporate debt, because they can't afford to and therefore they have to revert out of their, quote, tightening policy back to that which they do best. What will be the benefactors of that? Obviously, gold and silver, I think, will be the chief ones. And I think that's why gold and silver are behaving as they have, which is pretty good compared to what the stock market did last year, okay? In fact, gold had an unchanged year last year. Most people don't know this. 2021 close to 2022 close, unchanged. Silver's close in 2022 was higher than it was at the close of 2021 by about 3%. Compare that to S&P down 20%, NASDAQ down 30%, bonds down 30+%. So gold and silver were in effect saying, you're not breaking me. Why not? I think because they're anticipating that the breakage of these other assets is going to cause the Fed to do that which they're made to do: print money.
Right. And that's a very good point. I see gold and silver as having done their job last year, basically protecting purchasing power while the broader market fell dramatically. I'd like to talk about the relationship between the Fed funds rate and the broader market, because there seems to be an idea out there that if the Fed is forced to pivot and start cutting rates again, the stock market's going to somehow take off. But historically, the stock market bottoms in the year or two following rate cuts after a hiking cycle. So
Yes.
what's your view there? If the Fed is forced to cut, is that a sign that we're really headed lower in the broader markets?
It's a sign that they finally recognize their data points they look at are retarded because they're lagged to reality. Your unemployment numbers are going to change. They're going to get worse, but they're going to get worse later than the Fed had expected or hoped. Other data points they're looking at will get highly negative, but by then the market will already be in its second leg down. Okay. You're right about the historic point you made, is that once they've raised rates enough to cause the market to peak, okay, broken their little mini bubble, in this case a big bubble, then they have to revert. Okay, but the problem is historically that doesn't work. The stock market says we don't care. Why? Because ultimately the Fed doesn't dictate where that money goes. They may create the liquidity, but investors, asset managers, ultimately are the determiners of where to divert that river flow. In 2009, this S&P was in the 600s after having been at 1570 in 2007. When they printed the money then, finally, they've been printing all during the decline, of course. Investors said, okay, this is cheap enough of an asset. This is risk reward good. We'll buy the stock market. Okay, so investors made that decision. They stuck with it too long, but they did. Right now, I think a lot of investors, asset managers, and analysts are saying, hey, the risk reward up here, the stock market is really iffy. And, we've been gut kicked last year. The balanced portfolio notion was killed. 60% stocks, 40% bonds didn't work. Bonds didn't help. Owning bonds hurt more than, even stocks. They will make an asset reallocation decision. And I think that's what we saw last year, in effect, why gold didn't go down. Somebody was buying gold. Somebody was buying silver. Yeah, there were ups and downs and it fooled people, but net on balance, they had, they didn't go down during a huge down in these other asset categories. And I think that was part of the beginning of that asset reallocation. Right now, gold's pressing back at its highs. In fact, we're trading at levels such that if gold closes out Friday much higher than today's high, you're going to be making a new high monthly close for the entire bull market. Most people aren't aware of that. It's a statement. I think gold knows that, yeah, if they shift back to their other policy, we are going to be the benefactors this time, not the stock market. Why? Because asset managers and investors are just tired of that. They realize it ain't working. They've been gut kicked too many times. And I think that's what's going on. It's an asset class shift, and the Fed is simply providing a river flow again. And I think they will.
So you've stated that you think silver is going to make a massive move and whipsaw from a laggard to a leader, as I heard you say in a recent interview, I think with North Star Bad Charts. Can you walk us through how that happens?
It has happened before many times, where during a bull market in gold, silver and the gold miners, for example, the silver miners, the miners in silver will often lag gold, especially for instance, over the last 2 years, while gold has been in a big range and pierced the bottom of that range ever so briefly, enough to scare people. That was last summer. Okay, dropped down to 1613, I think was the low. The prior lows have been 1675. So you blew out all the price chart guys. They screamed, they pulled their hair out and got out of their positions. Gold immediately aborted, and now we're back pressing the highs. Okay. During that time, silver, instead of going sideways, was in a downward staircase. And so were the gold miners, even steeper. So while gold basically paused and went down some, they went down pretty seriously. They underperformed gold. But in uptrends, if you go back and examine them, you'll find periods of time there where silver will whipsaw, slingshot out of the hole and catch up to gold and outpace gold dramatically. Now, let's go back in history, 50 years. Gold has produced 3 prior bull markets. the early 70s, mid 70s, 1976 to 1980, 1999 to 2011, that were either sevenfold increases in price or about eightfold increases in price from bear low to bull high. Okay, 3 times over a 50-year period. The last bear low was 1,050 something. We've only doubled. So on a basis of what it's done before, if it went eightfold again, it'd be $8,000. So is that outlandish? No, it's done it 3 times before in 50 years. Go back and look at silver's relationship to gold over that period of time. And you'll see there's multiple times where silver was 2.5% to 3% of the price of gold. One time it was 6% of the price of gold. Right now we're trading about 1.3% of the price of gold. Those divide silver into gold as a percent. Silver spread versus gold is turned up in our view, shifted to positive since last fall, to where it's now back into a leadership position where it's likely to outpace gold. So if you get a week where gold's up 2%, silver's probably going to be up 4 or 5. Okay. Silver is likely, in our view, if gold ever went up to another 7 to 8-fold bull peak, in other words, replicated for the 4th time what it's done 3 times before, it certainly has reasons too, okay? Monetary reasons. And silver ever went back to a 2.5% to 3% ratio to gold. You do the math, talking a couple $100 silver. And that's not doing anything that it hasn't done repeatedly before over the last 50 years where that spread has reached those levels. So we think in this current upturn in silver versus gold, you could very well see silver snap so much on the upside that on a percentage basis, it will vastly outperform the mama market gold. Likewise, the miners, I think, will have their slingshot effect.
Yeah, I'd like to discuss the miners now, gold and silver equities, and how you see them positioned. I've heard from a lot of people that they appear very undervalued as a group, but I'm wondering, in the case of the broader market falling more deeply as you're predicting, initially, will the gold and silver equities and perhaps other commodity stocks fall along with the market, at least initially, before rallying from there?
Well, to some extent they have. Look at the GDX, gold miners over the last year has gone down while the market's gone down. Okay. Well, that's also because gold went down. Okay. So gold was having a corrective pullback and silver went down. So the miners went down. The question is, was it because of the stock market or because gold and silver were pulling back? I think it's the latter. Okay. There are times when the miners will divorce themselves from the stock market, and they're certainly vastly undervalued compared to the stock market. You know, we don't analyze fundamentals of companies. We analyze their technicals. We analyze the relative performance of various miners versus the mining sector. We measure mining sector versus the S&P. I don't think that assumption will prove valid that, if the stock market goes down, then GDX and SIL are going to go down. No, they're going to go up with gold. And I think that's going to shock a lot of people. Large asset managers in particular, I think, will plow into the miners because to some extent they tend to avoid bullion, direct purchases of bullion. And so they're more likely to go into stock symbols that are highly correlated to gold and silver. And commodities also, if you look at certain commodity ETFs like energy, XLE, for example, or look at the Bloomberg, they don't correlate well to the stock market. In fact, if you look at XLE, the energy sector, and to overlay it on an S&P chart, go back to 2015, there's like no comparisons at all. There's no linkage. You could link up the rainfall in Dubuque, Iowa with the S&P better than you could the chart of the XLE with, so those assumptions I think are false.
So I want to shift away from commodities for a moment and discuss the banking sector because we've seen a lot of issues there. Some are calling it a banking crisis. We've seen it spread to a number of regional banks. Credit Suisse obviously was in trouble. What do you make of all of this? And in terms of the regional banking sector in the U.S., do you think it's at risk of getting totally wiped out as a whole, consolidating deposits in the too big to fail banks like JP Morgan? And if we see further failures, does that also drive the thesis for gold and silver as more people might decide to go there as a safe haven?
That's a sector that the Federal Reserve cares about. They're strapped to the thighs together, the big banks and the Fed. Okay, they don't care about tech company goes under, or, internet, who cares? But, you jeopardize the banks, suddenly they wake up. Okay. Yeah, the regionals were the first victim here, but we back in late January, we had two reports. Now, this is back when we were near a high in the banking sector. In fact, the banking sector had been performing better than the S&P. So for instance, in June, S&P made a low and had a rally into August. Banks did too. But then in October, S&P went down, made a new low. Banks did not. Then we went back up and banks made a higher high than they had in between. So they look pretty good on the price charts. Not a new all-time high, but higher high than certain of the prior rallies. So when you looked at the banks and looked at the S&P, you said, gee, the banks, that's a good sector. We put out a report at that time in late January that said, watch this sector. Nobody's watching it. They're all looking at tech. This is the sector that matters. Well, 2.5 weeks ago, they collapsed. So we were a little ahead of events, okay? It started in March, but we had what effectively was a crash type event in the bank sector. The regional bank ETF made new lows below those of June. The S&P is not. The broader bank ETF, includes the big banks, also made new lows versus the lows of June. S&P is not. So on the downside now, the banks are leading. But look at some of the big 4 or 5. Bank of America, new lows below the June low. Wells Fargo, new lows below the June low. This would be like S&P right now being at 3,300, okay? Citibank, near the lows of June and near the lows of 2020. And some of the other bank stocks, big bank stocks, have vulnerable structures as well. But even the price charts of those three, Wells Fargo, Bank of America, are in new lows for the bear move, and Citi's close. So it's not just a regional issue. How come the big ones are below the lows of June, making new bear lows in effect? I'm not going to answer that question. I'm just going to point out the fact that somehow the market doesn't think it's just regionals. And the Fed has to be super concerned about that in terms of, do we keep doing what we've been doing? So the breakage in that sector is a big boon for gold. And it's possibly part of the explanation why gold is back pressing its highs again. If you can't trust your bank deposits, or you've got too much in there beyond the insurance rate, you either have to go open 4 or 5 more bank accounts at different banks, or you finally say, hey, maybe I should just own some gold. Anyway, so no, I don't think it's just regionals. I think it is that lenders will suffer because debt that's been accumulated during this paper bubble, a lot of the debt is false, will be revealed as such, and ultimately the lenders will pay big dues.
Very good points. And yeah, when I started seeing the banking sector fail, I actually added more gold to my stack right then and there. I was like, I need some gold. But I'm into precious metals to begin with, but hopefully we'll see, the general public.
Somebody else did too, obviously, right? Because that's what's happening here.
Yeah. So kind of the bear case for commodities has been, well, we're going to enter a massive global recession. Demand for things like oil and gas and copper, base metals, several of the other commodities is going to drop. So first of all, I want to put the recession question to you. What are the odds that the U.S. economy doesn't go into a recession? How deep do you think a potential recession could be? Is this something that could spread globally? And will it affect commodities, or are those supply-demand fundamentals too strong?
We've argued for over a year that we're not headed for a recession, we're headed for a depression. Okay. Now, I know there's a mathematical way to determine when it's a recession and depression. In fact, the 2009 bear lows, had it not been for the state of Texas outperforming economically the U.S., and you excluded them from U.S. metrics, as I understand this, the U.S. was in a depression. It was beyond recessionary numbers. But when you included Texas, that helped buoy the overall national numbers. Okay, I think we're headed for a depression, and I think it'll be reflected globally, not just U.S., which means there's no safe place out there. No, some other markets like China, I don't think are going down like we are, because they're not bubbles. China, for instance, at recent highs is only double where it was in 2009. India, however, went up 6-fold when the S&P went up 7. So India could be in trouble. That's one so-called emerging market that could, in fact, be a big bubble. Europe did not have the bubble type situation the S&P and the NASDAQ 100 produce. So while they all might go down together, reflective of economic downturn too, certain stock markets will only go down, far less than will a percent basis than the S&P. So I think the U.S. market is probably the most vulnerable in the world because it was the biggest benefactor of monetary excess. Now it's going to be the biggest dues payer. But I think that ultimately there'll be some economists who label this something other than a recession. Now, it may be a year from now before they do that. But I think we're headed for a recession. Okay, plus.
And how do you see that impacting the commodities market? How does that balance with the fact that you think commodities are going to take off here?
Commodities are still cheap. Despite the argument they're at 40-year highs, that is simply not true. Look at a Bloomberg commodity index and go back 20 years and look at it. And don't believe the stuff you're being told, okay? In fact, it's only, we were in the high 50s was the low. We're trading in the low 100s right now in a protracted, this is a year and a half pullback, actually. And it's only pulled back about 27% from its peak monthly close, okay? Some commodities have been hurt worse. Natural gas and oil, for example. They led the upside in the last commodity cycle from late 2020 to early 2022. Oil and natural gas led. We think they'll go in the upside this next time as well, but not as leaders. It's more likely to be food commodities. Exclude gold and silver from this because their correlation to commodities is not real good. Sometimes they're in sync with commodities. Sometimes they do things on their own while commodities stay depressed. 2015 to 2020, for example, gold doubled, commodities went down. Okay. But go back to the late 70s, we had a global stagflation where commodities went up big time with gold. They didn't go up as much as gold, but they had a big move, huge move during global recession. So there's another example of that. Again, you have to view it not as economics, but as monetary. And if the central banks revert to monetary easiness, which they will have to, they have no choice, it's going to go somewhere. That river flow will go somewhere. And if investors say, no, I'm not putting it in there again, I've had it with that sector, stocks, muni bonds, corporate debt, they're going to buy something else. And we think they're already buying gold and silver. They'll go back into commodities, and we've got some trigger levels on the Bloomberg that are above the market, not far above it, and even on crude oil, which has now, of course, been really slingshotted deeply, where we'll get an upturn again that will signal the second move. And I'm going to guess it's going to occur probably in the next month that this resurgence will begin. And it will occur despite global negative economics. It will occur because central banks are printing money. It's going to go somewhere. And it will go into the less risky, more potentially rewarding asset category. That would be commodities and commodity-based stocks.
Very interesting. So within the commodities sector, we've discussed obviously gold and silver that you're saying sometimes operates outside of that. And then you've also mentioned oil and gas. Are there any commodities in particular that you think are going to benefit from this commodities? Some are calling it a super cycle, bull cycle, whatever you want to call it.
You can look at cattle right now, it's pressed at all-time highs, okay? And everybody mentions that. They're all happy with gasoline prices down, but the price of beef has exploded, okay, forget that. We think food in general. Now, in particular, we've been focused on sugar. Now, sugars has a technical base both on price charts and its momentum charts going back years that looks so huge that when it engages, we're not sure where it's going, but it could be monstrous in terms of percent gain. You say, well, sugar, well, who cares? Well, sugar's in everything. Go down the grocery aisle, flip the box around and look. And where you don't think you'll see sugar, okay? So it's embedded in most foods. It's a food essential. That's one area to look at. We think the grains will be another area. And they've had a good pullback, coincident with the Bloomberg over the last year and a half. We think that'll be another area that likely will outperform the energy complex. So our bias right now is probably foods in general. Now, there'll be some exceptions, but sugar's one we particularly like because the technicals just look huge for something enormous on the upside. In fact, it's already begun a process, we think. We're watching grains closely. But if again, we think when the commodity index turns up again, and it won't take much, And like about a 5% rally is all we need to trigger it. We're going to especially focus in on the grains at that point, because I think that's probably where the better percentage gains will occur. And therefore, in stocks that are related to those particular markets.
Well, thank you so much for joining us today, Michael. So much knowledge shared. We really appreciate it. For those who want to hear more and learn more about momentum structural analysis, where's the best place for them to go online? And maybe you could give us a little bit of an outline of that service.
Yeah, we have a couple of subscription services. Our all asset category is $1,800 a year, or $475 per quarter. We cover all 4 asset categories, have about 5 reports per week, including a large weekend report, usually 10, 12 pages. We cover most of the big asset categories so you can integrate them. It's important to do that. We also have a gold silver report, comes out once or twice a week. And we also have a Bitcoin report, which most people aren't interested in, not because we haven't been right on it, but because Bitcoin's been down so much that people just don't care anymore, But I suggest that you focus in on look broadly. It's the best way to see markets today. It's not just look at your narrow focus market, because you get ambushed by on the right side or the left side by some other market that you weren't looking at. Like, for instance, what the banks just did, which did not surprise us, but ambushed a lot of people and helped cause gold to rally probably another $100 beyond what it otherwise would have done. You go to our website, olivermsa.com, and you'll find a contact page. You can click on it, and my email is there. Just request. I'll send you some sample copies of recent reports.
Great. Well, I'll put a link in the description below, so anybody who wants to check it out can just click that link. Thank you so much for joining us again, and hope to have you on again to continue the conversation sometime.
It was fun. Thank you.
Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.